So welcome everyone. Good afternoon, good evening, or good morning to you all, depending on where you are joining us from. We're delighted to hear you have you here again today for the second webinar in our current series focused on the topic of Pillar 2. We are, of course, also available for follow-up discussions after the webinar to address your specific circumstances in more detail. So please feel free to contact the speakers today or to get in touch with your usual BDO contact. So to kick us off, a polling question. For the first polling question, we'd love to hear about your key concerns around the global implementation of Pillar 2, by which I'm referring to countries taking action to seek to implement the Pillar 2 principles into their own domestic law. I appreciate that all of the lines within the polling question may be of concern to you, but if you could seek to limit your responses to your top 3 concerns, that would be appreciated. As you think through your response on this, some things to consider that whilst the OECD rules provide a framework, and that framework does not have direct effect in participant countries unless those countries seek to implement those rules into their own local legislation. And there are degrees of flexibility in how and to what extent countries may seek to implement those rules in their domestic law, and also the timeline with which they bring the rules into force. So the precise interaction of those domestic choices will vary depending upon what the group structure of your organization is. Okay, so a real mix of what is concerning you, but it seems like there's a particular focus on how do you connect your finance and tax teams across the globe to pull in the same direction in relation to this particular issue, with 67% of respondents stating that as a key concern. Excellent. Okay, so let's move on. So what are we covering today? Well, we have representatives joining us from the US, the Netherlands, Germany, Switzerland, and Hong Kong. And our focus today is going to be on providing some jurisdictional perspective on how the Pillar 2 rules are being approached in different countries and regions around the world. This is in part to give you an update on the status of implementation in some key markets that you may operate in, but also to flag some of the nuance and difference that we are seeing emerge in the application of the rules as we advise our clients around the world. So with that in mind, we'll start with North America, then move to Europe and Asia Pacific for general overviews of the state of play in those locations, before moving to some of the emerging issues that we are seeing to give you a flavor of the sorts of things that you might need to consider as you look at these rules on a global scale. We will then hopefully have some time for questions at the end. So without further ado, I'll hand over to Scott Klein to provide us with some perspective from a North American standpoint. Scott, over to you.
Thanks, Ross. You can hear me okay?
Yes, we can.
Great, great. So on the US side, Pillar 2 legislation is not expected in 2024, in part due to our current US political climate. Like many other issues in the US, Pillar 2 has become slightly politicized. So we had a bill that was introduced in May by several Republican lawmakers who would impose a retaliatory surtax of up to 20% on income earned in the US by companies from countries that impose a Pillar 2 tax with respect to US income. So it wasn't all the Republican lawmakers, but just gives a flavor of some of the discourse that we have. While US Pillar 2 legislation is not expected in 2024, the US has still been quite active. The US Treasury issued guidance on key Pillar 2 provisions that could impact US taxes in December. A couple of those provisions, dual consolidated losses and foreign tax credits for paying Pillar 2 taxes. So for dual consolidated losses, very generally, these are net operating losses of a US corporation that is also subject to non-US income tax called dual resident corporations. And the US corporation could potentially use the same loss that could be used to offset non-US income tax. So the US corporations generally precluded from using a loss that could also offset a foreign income tax, unless the dual resident corporation makes an election that it will not use that tax to offset foreign income tax. Well, for Pillar 2 purposes, the jurisdictional top-up tax can be treated as a foreign income tax. So Treasury came out and said that at least for dual consolidated losses that are incurred before 2024, those can still be used in the US, to be determined with respect to dual consolidated losses that are incurred in 2024 and beyond. So we're anticipating a lot of guidance still. Key takeaways on the creditability of Pillar 2 taxes. Just first, the IIR is generally not going to be creditable against US tax, whereas the QDMTT will generally be creditable against US tax. There is a facts and circumstances analysis for the QDMTT. Also, for purposes of determining whether an entity qualifies for one of the high tax exceptions against our CFC tax regimes, namely GILTI and Subpart F, the Pillar 2 top-up tax is generally not going to be taken into account, so that's unfavorable. Also, another tax unfavorable provision in the recent guidance, even if a CFC pays a top-up tax like the IIR that is not creditable for US tax purposes, the US parent entity still has to treat that tax as a quasi-taxable dividend under our Section 78 gross-up rules. So it's unfavorable in that you still have to include that as US taxable income, even though you don't take into account the tax. US multinationals have been very active with analyzing the GLOBE rules. Obviously, we are known for using non-US holding companies. Many of those non-US holding companies are in jurisdictions that have a qualified IIR. So basically, most, if not all, foreign subsidiaries are subject to Pillar 2 analysis now. Also, US subsidiaries held by non-US entities that have a qualified IIR. A trickier one with potentially unfavorable consequences involve US sandwich structures. So that's where we have a US subsidiary or a US PE that is held by a non-US entity, and that non-US entity has a qualified IIR and is held by a US parent. So not only are the US subsidiaries or the US PEs at the bottom subject to GLOBE taxes now, but the way that the allocation rules work, the entire US multinational group could now be subject to having to do a detailed ETR test because of that one US subsidiary or US PE that's held by a foreign entity. Also, disregarded US LLCs have proven to be problematic to the extent they're stateless entities, which is often the case. We've helped a number of companies restructure their US LLCs, either taking income out or eliminating the US LLCs. Other interesting Pillar 2 issues have been caused by US check-the-box regulations and other US elections that create US tax residency. In the commentary, they've explained that the creation of tax residency by means of an election is not outcome determinative to where the location of the entity is for income allocation purposes. So that has created interesting issues. Canada has released draft legislation back in August. However, they currently have not made the GLOBE rules effective. They're still waiting to legislate that. And so we don't know if they'll be effective in 24 or 25, but they did put forth an IIR and a QDMTT. And then Mexico has been a bit of a surprise in the sense that Mexico was a BEPS front runner, and they still have not implemented Pillar 2, and we don't have announcements from them. So that for the North American view, and Frederick, I'll turn it over to you for the Netherlands.
Thank you, Scott. And indeed, an EU perspective here. So the EU member states are under an obligation to implement the EU directive, which more or less replicates the OECD rules in the European Union. And this would apply to 27 EU member states. And they would have had to implement the Pillar 2 directive for the QDMTT and IIR for fiscal years as of December 23, and the UTPR for fiscal years as of 31 December 2024. There is an important caveat in the rules, an important exception that member states which only have maximum of 12 UPEs on their territory can opt for a delay of implementing the IIR and the UTPR. And other member states in that case would have to collect the UTPR amount. They would still have to implement certain other Pillar 2 provisions, particularly around exchange of information. By this date, by December 23, 5 member states have so elected and informed the European Commission, which are Estonia, Latvia, Lithuania, Malta, and Slovakia. What we've also seen is the European Commission and the European Council releasing a statement in November 23 that the administrative guidances which have been released by the OECD after the adoption of the EU directive are found to be compatible with the EU directive. Also looking at the wording in the EU directive, which again the member states must implement, this means that the administrative guidance will likely have very strong interpretative value when considering Pillar 2 issues in the member states. But again, it being EU law that's ultimately implemented by the member states, it will be the European Court of Justice who in the end has to decide on matters of interpretation and then on the actual value attributed to the OECD rules, particularly, of course, when some guidance could appear to conflict with the wording in the original rules. We've also seen, based on the latest status and the latest publicly released documents, that 4 member states so far, out of the 22 member states who have not elected under 52 delay based on the limited number of UPEs, that there are 4 member states, who are who do not yet have their legislation implemented. And these are Poland, Greece, Spain, and Portugal. Apparently, Spain has released draft legislation, and the others have not yet released any piece of legislation so far. Again, I note that the implementation of the directive can be form-free, so merely a reference to the EU directive in some ways could be sufficient as legislation. In terms of the potential differences we could see in the different pieces of legislation, again, we are likely expecting a lot of uniformity, clearly because the directive mandatorily prescribes what the member states could do, but there might be some flexibility for states to differ in 1, the design of the QDMTTs, 2, some local compliance and administrative obligations might differ from state to state, for instance, in terms of filing deadlines or the reference to accounting standards that may be used. And I think a development that we'll likely see among the member states is different practices in dealing with matters as what refundable tax credits are. And potentially, of course, we could see member states switching from tax incentives to non-tax incentives, simply because the Pillar 2 rules would no longer encourage the use of tax incentives. Over to you, Benedict, for a view on the German implementation.
Yeah, thanks. Can we go back? Yeah. So in Germany, in December 15, the EU directive has been implemented as a national tax law in Germany. So Pillar 2 will be or is effective in Germany for fiscal year starting after 31st of December 2023 for the IIR and QDMTT, and a year later for the UTPR. So we are here in line with the request from the EU. Some key current considerations regarding Germany is while implementing Pillar 2 as a national tax law, they have changed some other German laws as well. Most of them being tax laws, and here the most important changes, adjustments are adjusting thresholds that have been in these laws to the Pillar 2 15%. But in addition, they have changed our German GAAP law, the HGB, the German local GAAP, and added disclosure requirements. And this is already relevant for financial statements ending for the financial year 2023. So the financial statements as of 31st of December 2023. And here, for under German local GAAP, both for separate and group financial statements, you are required to disclose your exposure to Pillar 2. And the requirements are designed similar to the one you're probably familiar with, according to the IS 12 amendment. So this is the current status in Germany, and yeah, for Switzerland, hand over to you, Dennis.
Thank you very much, Benedict. In Switzerland, we had first to amend our constitution in order to be able to introduce both Pillar 1 and Pillar 2 in our legal system. And therefore, we had a votation on the 18th of June 23, and 78.5% of the voters said yes to this constitution modification. On this basis, the Federal Council prepared an ordinance, and finally, we had a long suspense, but a few days before Christmas, on the 22nd of December, the Federal Council decided to begin the implementation of Pillar 2 as of the 1st of January of this year. The Swiss model is a QDMTT. That means that this QDMTT qualifies for the safe harbor rule, and we have all the conditions requested. For the international aspects, that means for the IIR and UTPR, the decision has not been taken yet by our Federal Council, but it will come later on. In order to be QDMTT safe harbor compatible, the Federal Council decided that the Swiss groups would have to apply Swiss GAAP in order to make the calculation of the minimum tax. I come on later with certain aspects regarding the federalism in Switzerland, and therefore I give you the word, Jack.
Yeah, thank you, Dennis. Good evening, everybody from Hong Kong. I guess just from an Asia perspective, I'll just begin with the kind of the obvious observation that Asia, is pretty diverse in terms of a mix of OECD members that have been front-running some of these rules, Japan, Korea, etc. We have developing markets like Vietnam, Malaysia, Indonesia that have announced plans. And then in terms of investment hubs like Hong Kong and Singapore. So maybe what I'll do is quickly run through kind of the status of the investment hubs first, because we do have some recent developments, and then move on to the rest. So next slide, please. So I guess the most immediate update from an Asia Pac perspective is right around Christmas, the Hong Kong issued a consultation paper. We've known for some time that Hong Kong was going to adopt the Pillar 2 global minimum tax. That's largely driven by the desire to maintain Hong Kong's status as an international financial center. So we knew this was coming. The flavor of what was released from the government is kind of the features are there's going to be an IRR implemented, the Hong Kong equivalent of a domestic minimum top-up tax. The goal of that top-up tax is really to be qualifying. So I guess if I were to summarize kind of the features of what's being proposed is broadly in line with the OECD. There are some nuances, which I'll go into in a second, but in terms of the rules coming into effect, they're expected to be effective from 1 January 2025. In terms of the considerations that we've seen so far based on the rules, I guess one important thing, given the territorial nature of Hong Kong's tax system, is how the definitions of residency come into play, how it's reasonably common for Hong Kong to be used as invoicing centers with limited substance, etc. So defining tax residency has been a difficult task or not straightforward task for a number of different groups. There are other aspects of the territorial tax system that are also being considered. Within the detail of the provisions, there is some question about the outcomes or the calculations when applied to calculate the Hong Kong minimum tax versus the globe rules. Some of that is driven by accounting standards or accounting differences. And I guess one of the other points is Hong Kong generally doesn't apply penalties, but one feature is similar to CBCR regime in Hong Kong. They've also implemented penalty regimes that are pretty severe. And so that's something to look at. The other part is also about consolidation of the different entities and stateless income, etc. So I think in terms of next steps, we expect the rules to proceed through the legislative process pretty quickly and come into effect towards the latter half of the year. Similar to Hong Kong, Singapore has also announced its intention to implement the global minimum tax. In the budget announcement last year, it was pretty clear that on one hand, Singapore would implement the rules, but on the other hand, they were cognizant of the developments taking place internationally and the desire for Singapore to balance kind of international cooperation as well as, coming up with a set of rules. We expect our understanding is that the tax authorities and the Ministry of Finance have initiated informal discussions on the model of the rules that are likely to be implemented. There is a question of whether the IRR and the minimum tax will be implemented at the same time or become effective for 2025, or whether that gets postponed a little bit. And then, of course, with a place like Singapore, there is a question about incentives and what does that mean for Singapore's competitiveness. So we'll talk about that a little bit later. In terms of shifting now to kind of the broader APAC, at last count, the OECD announced that there were maybe 36 jurisdictions that have either legislated the implementation of Pillar 2 or have announced the intention to do so. Many of those jurisdictions are in Asia, with Japan introducing an IRR that became effective April 2024. Vietnam, Korea, Malaysia similarly as well. Australia, Thailand, and Indonesia have announced plans to implement Pillar 2, but we're still waiting for detailed legislation. I guess the final concluding point I'll make is when we look at kind of the material economies in the region, many of them have announced. And so one noticeable fact is compared to this time last year, there's been quite a lot of progress from governments in terms of either enacting the legislation, proposing it, or announcing plans to do so relatively quickly. The noticeable exception to those two is India and China, where no detailed announcements have taken place. One thing to watch for is kind of how India and China view the broader OECD and whether some of their views on taxation get shifted towards the UN or other avenues as well. So we still expect that they will introduce it. It's a question of timing and effective date. So I guess that concludes kind of my overview of Asia Pacific. I'll hand over to Scott to kind of talk of some of the emerging issues. Scott, over to you.
Thanks, Jack. So it's a very meaty topic. We're going to do it really quickly, so there'll be a lot that'll go unsaid, and there's so much work to do around this area. So differences in the way that transactions are taken into account for local tax purposes, which is the numerator in the GloBE ETR, and for GAAP purposes, which is the basis of the denominator of the GloBE ETR, coupled with adjustments to the globe timing and base differences, will cause the GloBE ETR to deviate from a GAAP ETR. So with respect to deferred taxes, in countries where the statutory rate is greater than 15%, deferred tax assets will generally have the effect of producing a higher globe ETR compared to a GAAP ETR in the year the DTA is recorded, whereas deferred tax liabilities that reverse within 5 years will have the effect of producing a lower globe ETR compared to a GAAP ETR in the year that the deferred tax liability is recorded. There are exceptions to that, particularly deferred tax liabilities that don't reverse within 5 years, tax goodwill, for example. But on this list here, R&D costs and advanced payments are generally going to produce a deferred tax asset in the year that they're recorded, and can have the effect of producing a higher globe ETR than a GAAP ETR in the year. Whereas installment sales will generally have the opposite effect. And if the installment sales, for example, or any other DTL for that matter, will not reverse within 5 years and can't be tracked, at least for now, each installment sale, then you don't get to take it into account in the numerator in the year that you're recognizing the sale. So that could have really significant ETR impacts. Also, inflationary adjustments and debt releases are along the lines of a globe base difference, in the sense that if the debt release is taken into account as income for US GAAP or for GAAP purposes rather, but not for tax purposes, you could have a really low ETR. Inflationary adjustments as well, not taken into account for GAAP purposes, but taken into account possibly to reduce your tax and thus your tax rate. We've seen items subject to fair value accounting have significant impact. For example, public warrants that fluctuate with fair value, so impact your income, but not subject to tax in the current period. So suffice it to say that our M&A structuring decks now need to consider GAAP accounting considerations to determine Pillar 2 taxes, in addition to all the models we've been building to help companies estimate their globe taxes on these deferred tax movements. So deferred taxes now matter, and they matter significantly. So I'll turn it over, Benedict, to you for some additional local deferred tax policy matters.
Yeah, and that is, now we can stay on the other slide, please. Yeah, it's, to the last point, the local deferred tax policy matters. It's just another point how important deferred taxes are now for Pillar 2 purposes, because under German local GAAP, if you have a surplus of deferred tax assets over deferred tax liabilities, you do not need to recognize this DTA surplus. That's the policy choice, and a lot of German companies make use of this policy choice. But the design of the current Pillar 2 tax law as implemented in Germany would not allow to use this non-recognized portion of the DTA surplus. So it's not, and you cannot apply Article 441C or Article 9 like you would do for IFRS, where you have where you ignore any adjustments of valuation or recognition adjustments. And this is of course unfavorable, because if you think about, you have this DTA surplus that you do not recognize, and at the point in time when the DTA reverses, you're missing on the tax expense, which will impact your ETR negatively if you do not have this. So this, just because you account for under German GAAP instead of under IFRS, for example, that would be unfavorable and, yeah, a disadvantage. And you might have to pay top-up taxes just because of the accounting system you use. And Until now, the German legislator has not taken any actions regarding this problem. It has been addressed to him several times over the last year. But we are waiting of a so-called BMF-Schreiben. A BMF-Schreiben is a Federal Ministry of Finance circular, and that should come out hopefully within the next couple of months. And in this circular, we are expecting a clarification on this matter especially, but on a lot of other matters as well. One, for example, being incentives, where we can switch to the next slide. Because tax in... Oh no, sorry. Yeah. We will go to incentives after this slide. First, we have a look at federal system considerations. And for this, Dennis, I hand over to you.
Thank you, Benedict. Yes, we are speaking of federalism, and in Switzerland, we are a little bit the specialist for federalism. Under our federal system, we have 3 levels of perception of taxes. We have the federal, the cantonal, and the municipal levels. And this new national supplementary tax is a national tax. That means should be normally perceived by the Confederation. But here, as the cantons are responsible for the tax assessment and collections, also for the federal taxes, the Federal Council decided that it's up to the canton to perceive this new supplementary tax. But as it could be complex if, for example, a group subject to this tax would have different companies or permanent establishments in different Swiss cantons, in that case, it was decided to implement a one-stop shop. And that means that only one canton will be competent to levy the tax for all the entities of the Swiss group. And then there will be a sort of aggregation, and there will be a split between the different cantons based on specific rules I will not explain here for this webinar. What is important to mention is that at the end of the day, there is a part of the global revenue due to this new tax, 75%, will stay by the canton and 25% will go to the Confederation. One more point to mention is in anticipation of the implementation of this new national supplementary tax, certain cantons decided to raise their own cantonal tax in order to get to a threshold where there should not be a need to perceive this new tax. Whether it's a good calculation or not, the future will tell us. But don't forget that in Switzerland, we also have a very complex system in order to split the different financial means between the cantons. It's called péréquation. And therefore, even if a canton decides on its own to raise its taxes, at the end, it will have an impact about its financement. So, one thing to keep in mind is there will only be one canton responsible for the perception of this new supplementary tax, even if many more cantons would be implied. Benedict, back to you for the German perspective.
Yeah, thanks. So in Germany, we do have a federal system as well, but given the already higher tax nature of the German tax regime, there's currently no discussions about implementing a new tax or changing any tax rates just because of Pillar 2. So there shouldn't be any adjustments in our federal system tax rates because of that. And now we can switch to the next slide and talk about incentives. Why incentives is another emerging issue we want to discuss here, talk with you about. Especially the tax credits. So tax credits under Pillar 2 can be a complicated matter, and it's a very distinguishable matter. For tax credits, Pillar 2 wording, they are refundable tax credits, transferable tax credits, qualified, non-qualified, marketable, non-marketable. So you see there's a lot a lot of new definitions or distinguishments you have to make to understand how an incentive can impact your Pillar 2 calculation and your Pillar 2 top-up tax in the end. So I start with the German perspective. Luckily, or at least luckily for Pillar 2 calculation, there are not too many tax credits in Germany. The probably best known currently is the so-called Forschungszulage, is research allowance, and this should be qualified as a qualified refundable tax credit. So that's a good thing. But in addition, there's another one currently being discussed or planned to become effective in the future, a climate protection investment bonus. And given the current design of this tax credit, that would not be a qualified refundable tax credit with the respective impact on the ETR. So, and for the US perspective, Scott, I give it to you.
Yeah, just real quickly. So we have some very lucrative credits in the US and incentive deductions. We have clients that have R&D credits, energy credits, FDII deductions that can produce a 10 to 15%, 17% rate benefit. So these can have very significant impacts on Pillar 2. And then the substance-based income exclusion does not sufficiently remediate these ETR reductions. But what we've seen is we've seen a lot of countries trying to broaden some of their incentive regimes, whether it's converting tax holidays to deferred tax assets or deferred tax attributes that can carry forward. So I think this year is going to be very interesting, seeing all the jurisdictions and some potential new types of incentive regimes and how the OECD reacts. One interesting point I've been thinking about is the definition of a QDMTT in paragraph 118.13 of the February administrative guidance, which says that the definition of a QDMTT prohibits a jurisdiction from providing any benefits that are related to the QDMTT or the GLOBE rules. So whether that is broad enough to take into account some of the new incentive regimes, I think if they're not tied specifically to GLOBE, I think a jurisdiction shouldn't be penalized just because it's providing a new incentive regime at a date after GLOBE was enacted, compared to incentive regimes that have existed for a while. So this will be a very interesting topic. So over to you, Jack or Ross, on UK and Asia Pac.
Yeah, thanks, Scott. Look, I think from an Asia Pac perspective, incentives play a critical role, right? In the age of globalization, governments in Asia used corporate tax incentives to attract investments, whether that's to build manufacturing capacity in places like China, Vietnam, Thailand, etc., or even to attract capital flows in places like Hong Kong, Singapore, etc. At a policy level, I think we expect that those incentives will continue to be in place, if for no other reason than, of course, there are as a part of government policy to incentivize those groups that are not in scope of GLOBE. And so just as an example, with the fintech space, right, the governments view tax incentives as important for startup economies, etc. So we expect that to continue. In terms of the adjustments to existing incentives for in-scope groups, I think we already got a bit of a preview on what's likely to happen, and also similar to what Scott talked about in the region, and that was with Vietnam. For those of you who are not familiar, what happened late last year was that Vietnam, on one hand, announced intentions to adopt GLOBE, but then also announced on the back of some lobbying that they would offer either some kind of refund or some kind of payment back to the affected taxpayers The OECD, of course, reminded Vietnam quite forcefully in person and in writing about the no benefit requirement that Scott just talked about. So I think what we've seen is Vietnam backtrack a little bit and then talk about maybe adjusting their focus to attract investment in the form of maybe an investment fund, in the form of maybe modifying some of their credits. So I think the battle for investments using, tax holidays, tax rebates, patent box regimes, those will continue. And then I guess if I'm forecasting to kind of the rest of the year, what we expect to see is, of course, non-corporate tax-based incentives, whether that's GST relief, withholding tax relief, tax holidays, special economic zones, refundable tax credits, with the Asian flavor, etc. So expect that to we will see more of that in 2024 as governments grapple with the net impact of adopting these globe rules. So I guess I'll hand over to Ross to kind of wrap up and also talk about UK, Ireland.
Thank you. Yeah, so just a couple of comments on UK, Ireland to extend the theme around the expenditure credits. So the audiovisual expenditure credit will replace the audiovisual tax reliefs that you may be familiar with in the UK. And likewise, the video games expenditure credit is replacing the video games tax relief. And the clear driver for both of those is to make them above the line refundable credits that would retain their value in a Pillar 2 environment in a better way than the current regime would. So let's do one more polling question as we start to bring the webinar to a close. Here, I'd love to get your thoughts on how you plan to handle Pillar 2 compliance globally, including how you will deploy your internal resources to address the inherent challenge of these rules. As you reflect on this, I'll just draw out again some of what we've heard today. Namely, there is a global framework, but within that framework, there are differences in local approach and technical nuance to address. Many territories only have draft law at this stage, and even those where there is enacted law, guidance continues to evolve. We note that a number of businesses have centralized finance and tax functions and may struggle to stay close to developments in their local countries of operation. We are also conscious that Pillar 2 is just one of the increasing burdens being placed on in-house finance and tax teams. And finally, we've not touched on it today, but Pillar 2 represents a huge systems and data challenge, which is a topic that we'll be focusing in our next couple of webinars. So how are we doing with the poll? Okay, so it seems like there is a strong bias towards outsourcing at least a component, with probably about 75% of respondents saying they will outsource at least some component, and about 25% saying they plan to manage this wholly internally. Perfect. So if we move on, we just wanted to share with you some resources that we've got available as you start to wrap your heads around how you comply globally. So we've got a tracker that is keeping track of the status of Pillar 2 implementation around the world, and you can access it through this link, which will be available to you when we share the slides after this session. And there's also various other articles that we've got to support you in understanding the basics. And of course, anyone on this call or part of our wider global tax team would be delighted to have a more in-depth conversation with you to help. Moving on then to upcoming events. So we had our first webinar back in December. If you would like to watch that again, or you didn't get a chance to join that, you can access the recording and the slides from that webinar again through the link that will be available when we share the slides. We've got a couple of webinars coming up focused on the technology aspects of Pillar 2, which will provide some great insight into what is available in the market and how we're seeing our clients implement technology as part of their overall Pillar 2 solution. And then a bit later in the year, after the main slug of audit and disclosure obligations have settled, and we've got a bit more of a detailed view on how the local compliance will look around the world, we'll have a bit of a deeper dive into that and provide some perspectives on some of those specific issues. So with that, I'll maybe just turn it to some questions. I think we've probably answered most questions as we have gone. There's been a couple of questions posted in the chat. If there's no more questions coming through, what I'll just do is I'll wrap up from my side with a few observations, which would be the rules are clearly complex, and there's perhaps a significant amount of work to do in order to assess the impact of the rules for your organization, including sort of technical assessment, working with your auditors, thinking about impact on existing processes, existing governance, systems and data challenges, training requirements. But it also includes the inherent global challenge that arises on local implementation of a global framework, as we've been hearing today, and all the nuance and permutations that may introduce. However, as we touched on in the first webinar, it is possible to make that workload manageable by breaking it down into steps and looking at approaches to simplify and eliminate some of that complexity so that you can help yourselves to focus as an organization. There is at least a global framework, and getting a good grounding of that is an important first step to which you can then apply the local nuance. So with that in mind, I think I'll probably draw this to a close.